a lot of people, probably including myself, when I heard these campaign promises, I was like, there's no way this is going to happen. But we do have some of it. I think it's most important for business owners is it made the qualified business income deduction permanent, which is essentially 20% of the net profit.
Yes, you hear all about this, things happening at the federal level, and that's the talking points and the things you hear on the news. But there's a lot of stuff happening at the local level where, you can have some really important influence.
If you don't report your cash tips on your taxes, you're committing fraud. So now you're not committing fraud up to $25,000 of cash tips. Then you also have the no tax on overtime, I think is a great move, and it's good for everyday families and Americans.
Hey everybody, and welcome to another episode of the Next Gen Strategies podcast. Joining me as always, Mr. Tyler Davis, and we have a very timely podcast for you today. We're kind of taking a break from the interviews and some of the things we've been talking about, different subjects, because we have something called the One Big Beautiful Tax Bill that has been signed into law recently. And so it'd be a good time to let the CPA talk a little bit about what folks can expect, maybe some things that have been rumored about the bill or some things that are actually now included in the bill that, whether you're a business owner or even individuals, it would be really helpful for you to know some of the things that have been written in the bill, some things that maybe still be a little bit of gray. So Tyler's going to do his best today to talk a little bit through some of the key points of the bill. I'm going to do my best as a non-CPA to ask him a couple questions as we go along, and hopefully we find some value as part of this, and we'll see as things get rolling along. So Tyler, let's get her going.
Anytime you see a sheet of paper, I'm coming with taxes. So the One Big Beautiful Tax Bill, I don't know what the acronym is going to be for that yet, because it used to, the one before was TCJA. This one, I don't know if we're going to call it the big bill or the Big Beautiful Bill or what we're going to do with it. But, this bill was done through budget reconciliation, which if you're familiar with that at all, it's a process in which, legislators are able to get some legislation through a little more effectively. We're not going to talk about all the things that were in that bill that were not tax related, because there's just lots of other things they snuck in there. But I kind of grabbed the things that I thought were pertinent and important for tax planning purposes for 2025 and into the future. A lot of this bill was, trying to come in with some of the promises from the campaign trail for tax purposes. The big thing he talked about was trying to extend his original tax legislation. And if you don't remember from our previous episode, a lot of those in the TCJA sunsetted at the end of 2024 going into 2025 , right? So this bill needed to extend a lot of those, and if it didn't, we were going to see a lot of tax increases. So, why I say that is we basically averted the 2026 tax cliff that a lot of people were talking about. Like, hey, if this does not get done in Congress, taxes are going to be a lot different. So it did get done, and I do have some things to kind of go over. It made a lot of things permanent that were not permanent, and it did add some new things. So from a permanent standpoint, the original tax rates and standard deductions that were set in TCJA are now made permanent. There's a big shift between prior to TCJA and that era that we're in now. There used to be a smaller standard deduction for individual tax returns, and you would get exemptions for the individuals that were in your home. They got rid of the exemptions and increased the standard deduction pretty dramatically. For the most part, kind of a wash. There are some scenarios where it was better or worse, depending on your situation. Worked well for people who didn't have as many kids, because that they just seen that standard deduction increase. So that was made permanent, and we usually see that standard deduction increase. It's usually indexed with CPI or inflation. So it's around over $30,000 for a married couple now. And that usually bumps up a little bit over time. The other one that I think is most important for business owners is it made the qualified business income deduction permanent, which is essentially 20% of the net profit of your business you're getting as a tax deduction, which is very significant. I think we said huge in the previous episode, right?
That we said, yeah.
That was a smack to the head. If that sunset and went away, it would make a big impact on most small businesses, because it does have a phase out on income limits. So it really was designed for the average small business in mind, and it's very beneficial for that.
And what were the different entity types that were covered? Was that most entity types that were covered underneath the QBI? It wasn't just like a standard LLC. It was like all the
right. Pretty much anybody who had a Schedule C on their tax return, which meant they had a side hustle or any type of business. There are specific rules about if you're an SSTB, a specified service or trade business, that makes the phase-outs a little bit more aggressive for income, but there were really no businesses that were ineligible for that program, and that continues now. And they actually did increase the phase-out income numbers as well, which makes it more open for a little bit higher earning business owners. So that was really great to see. I'm glad that one stuck around. Another really important one was the estate tax exemption increased and was made permanent. So when I say estate tax exemption, you hear a lot of people talk about, when you inherit something, you're going to have to pay all these taxes. That was a little bit more prominent years ago, because before the TCJA, the exemption was $6 million. These days, with inflation, an estate being worth $6 million is not out of the ordinary when you add in all the real estate and stuff like that. TCJA upped that, and this update with the big, beautiful bill upped it even further. So it jumps to $15 million per person, so up to $30 million. So the lion's share of estates are never going to have a federal income tax issue, which was fantastic for, specifically, think about family businesses. They can have a significant amount of value when they pass on through an estate. So if there's an unexpected death and a transition period hasn't happened yet, federal tax issues are not going to be as significant unless you're much higher than that $15 million mark. I get that question all the time, like, oh, my parent died. What am I going to have to deal with taxes? And it's always nice when I get to tell them nothing. It passes to you tax free. Now there's some stuff with retirement accounts and things like that, sure, but that are different. But it's good to see that. The other big one, the one that I'm going to be talking to people a lot about, is that bonus depreciation has brought back up to 100% and made permanent. So bonus depreciation, basically what that is your ability to deduct an equipment or an asset purchase immediately in the year you bought it. Normally, when you buy a big piece of equipment or a big piece of real estate, you have to depreciate it over a period of time that's in the basically tables us accountants use determining useful life of that. So like a residential piece of real estate is 27 and a half years, and I think a commercial property is just over 39. Then like a trailer that's 50,000 might be 7 years, right? Mm-hmm. What this does is it allows you to say, hey, you know what? I want to deduct all of that cost year one. And it's a pretty effective tax strategy for especially folks in real estate, because they're using debt to acquire these properties, and they're able to take a huge deduction if they do certain strategies like cost segregations, and using bonus depreciation, they get a big old deduction in the year they acquire a piece of property, especially in a year they're relatively profitable in other areas. That was coming down. The bonus depreciation was falling down to 40%. So this bill brought it back up to 100. So it gives a lot more options for taxpayers, and especially those in the real estate game. So it's going to make those cost segregation studies a lot more effective for real estate kind of, I don't call them moguls, but the ones that are out there doing the Burr method, buying, rinsing, repeating, getting together commercial or residential property to rent out. So those are some of the permanent wins, and we do have some new stuff. Kind of the what do I call it? The big items he was talking about on the campaign trail.
The ones that stuck out as he was campaigning, again, good or bad, but these are the ones that got the cameras and the attention on them for sure.
Got the people going, right? And a lot of people, probably including myself, when I heard these campaign promises, I was like, there's no way this is going to happen. But we do have some of it. So the first one is the no tax on tips. So what does that actually mean in the legislation? People are a little bit disappointed with this one, just because you can get up to $25,000 in tips tax-free, but there are some specifications on what those tips are, and they're primarily talking about cash tips. So I hear a lot of people saying, well, I wasn't reporting my cash tips anyhow. Well, I don't want to hear that. I'm a CPA. Don't tell that to me, because you're supposed to. So I will still take this as a win, because if you don't report your cash tips on your taxes, you're committing fraud. So now you're not committing fraud up to $25,000 of cash tips. I'll take that win any day of the week, because it actually makes it legal to do that, right? There's some other rules on that, and we'll see things come in terms of W-2s and how that's all reported, but inherently those tips should pass through in the first $25,000 tax-free. It does phase out for individuals if they make over $150,000 a year or $300,000 as a married couple, but I assume that won't be a huge issue for those who are doing tip jobs. Then you also have the no tax on overtime. So this one is $12,500 for a single filer or $25,000 for a married couple. So I was just actually telling my father about this over the weekend because he works a significant amount of overtime. I was already doing some back of the napkin math for him. I'm like, I think you're going to save, maybe $2,500, $5,000. The way this is going to work is you're going to get that as a deduction. So most likely your W-2 and your tax withholdings will be the same. You could go in and probably adjust your withholdings and take out less in taxes if you wanted to. But if you don't, you're going to see that deduction pass on to your individual return, and you're going to see probably a refund or a larger refund as a result of that. I think this one has a lot of positive support, and a lot of people that are really happy with how this one landed. I think it's a reasonable amount. A lot of times you'll have, usually in a married couple, one of the spouses works a lot of overtime and the other doesn't. So getting up to $25,000 of that tax-free, pretty nice. It has the same income phase out, $150,000 for a single person and $300,000 for a married couple as well.
So on that piece, like that sounds fairly straightforward to a certain degree on the personal side or the employee side. Obviously there's the other side on the employer side.
Yeah.
So curious what your thoughts are on the dynamic and whether it's, there's positives and negatives, obviously, but kind of what do you think you see that piece?
I think the main negative is it's just another thing that's going to have to be, tracked for, reporting purposes on the payroll side. I mean, most of the payroll platforms already see OT on the pay stub, so it shouldn't be too hard. But what they're really going to have to do is maybe update the W-2 to reflect the overtime very clearly on those forms, because we don't want employees having to grab like their year-end pay stub and trying to grab that number.
Yep.
So that's probably something the big payroll processors are going to work on how to pull that into a W-2 or have some piece of readily available information for taxpayers to drop in their tax return, because there will be a new form that's created likely on the 1040 that's attached to it that shows that deduction and it flows through. But I don't think it's going to be a big lift just because that data is already tracked. And I think it's going to probably encourage employees to want to work overtime, because they're going to want to work and grab up to $25,000 in overtime.
Sure.
So, I mean, I think that's nice if you're an employer who struggles to get folks to want to do OT, because a lot of times you'll hear people say, well, it all gets taxed anyhow, and I barely get any of it. Well, this kind of helps with that pretty significantly.
Sure.
On the federal level. The only downside to this is, and it's a short-term thing. This one sunsets at the end of 2028. So this is not a permanent. When we were talking before permanent changes, this is a campaign promise that's lasting basically the length of the president's term. So the likelihood of it getting renewed, maybe it will be. Maybe it'll be so vastly popular, people will want it to stick around. And I kind of hope so, because I think it really encourages that extra kind of go hard, work ethic, to get those extra hours in.
Sure.
A couple other cool things too that snuck in. They're going to make it able to deduct car loan interest up to $10,000. It does phase out kind of quick. Phases out $100,000 individual, $200,000 married couples, but you should be able to deduct up to $10,000 of car mortgage interest. Believe the car has to be bought as of 2025. So the new car I bought at the end of 2024 doesn't count, but 2025 forward, that's going to be there as well. There's also a senior deduction. So we're looking at a $6,000 deduction for taxpayers, I believe, that are over the age of 65. I think this was primarily aimed at trying to make that promise on no tax on Social Security, because if you give an extra $6,000 deduction, I think they did some statistics on how that would wipe out pretty much a lot of tax on Social Security for a lot of taxpayers. So we're going to see that. That does have a phase out on income as well. So you have to pay attention to that. If you have other retirement income sources, you might get phased out. Another good one was child tax credit bumped to $2,200 rather than $2,000. So it's good to see that jump up. And they expanded the dependent care credits, which right now you can get some tax credits for the cost that you pay for your child to go to childcare. They expanded the thresholds in terms of how much it gets phased out based on income, as well as some of the amounts. So we like to see the emphasis they're putting on childcare credits or child credits. There were some campaign promises surrounding that. I don't think this one meets some of the campaign promises they were going around and talking about. They had a lot of discussion about, stay-at-home parents and things of that nature, or grandparents that take care of kids. But it's something that they threw in here that does help, because credits are dollar for dollar and they're much more impactful than deductions. There's also these Trump accounts. Not a lot of details on them just yet, but they're saying, I believe, babies born between 2025 and it might be 2028, but I know for sure as of you gotta have a baby born in 2025, you're able to put back money into like an investment account that's similar to like a retirement account, but the kids get access to it at 18 and it can be invested. So you can put it in there and get a tax deduction. It grows. And then I believe you get a $1,000 bonus credit if you start that with a newborn in 2025. So we had a newborn in April. If I put $1,000 into that account, they're going to throw $1,000 in as well, and I get a tax deduction. So that's really cool.
They being the federal government's is going to kick that in through a tax credit.
Yeah, I'm assuming they're not depositing the money.
Yeah.
I'm assuming you're just going to get a tax credit. And
yeah. It's not going to be like the COVID check that, came. I don't know. But it'll be more of like it'll come through in a different. Yeah.
And that's a lot of the things with this is that there's nothing fully kind of codified out in terms of how these things are going to be laid out, but they'll be working on that now. Once it, gets signed, now it goes down to the taxing authorities to make the forms and figure out how this all works. But we've seen a lot of things with 529 accounts and this that are really encouraging investing in kids and giving tax advantages for it. So I love to see that. Said that before, the legislators are trying to pass laws with tax code to kind of incentivize people to do the things that they want them to do. Now, one of those is real estate investing and business growth. And now we're seeing some emphasis on investing for kids' futures, which I think is a great move. And it's good for everyday families and Americans. The other one that I loved seeing back, because we only had it briefly during COVID, was now that the standard deduction's so high and to be able to deduct charitable giving, you have to itemize. And by itemize, you have to add up all these different things that you're allowed to, and that number needs to be higher than what the standard deduction is to make it worth it. It's things like home mortgage interest and property taxes and state and local taxes, healthcare expenses over a certain threshold, all these things. It's actually more and more rare for people to itemize these days, unless they are very significant in terms of their charitable giving. Well, this in the big bill is now allowing up to $1,000 to $2,000 for charitable giving, even though you're not itemizing. We had that during COVID for a minute, and I really liked it because it helps all the nonprofits out there too, because now people don't feel like they're not actually getting a tax deduction for doing charitable giving until they get to a huge amount that they're giving. So Love to see that. There are probably a lot of Americans who average right in that wheelhouse of $1,000 in giving a year. So that'll be great to see that come back in and folks get rewarded for that charitable giving. So really that, for the most part, is the big ones. There's some stuff going on with, EV and clean energy. There are some tax credits revolving around that, and they're all going to get phased out. That was a part of this bill that they're like, we're getting rid of all the EV stuff that's, giving tax credits for your, electric cars and stuff like that. So if you have an electric car purchase in mind, I believe most of those phase outs to get rid of it are ending around September of 2025. So you might want to go buy your EV now if that's what you're considering to try to grab those tax credits. I noticed that. The other thing that they did was there's this big issue, or one of the biggest criticisms of the TCJA was what you'll hear people say, the SALT limits, so state and local tax limits. Right now, when you itemize your deductions, you're only able to deduct $10,000 of state and local taxes, which by and far for high tax states and or higher than average income earners is not all of the state and local taxes they pay, because you got to consider you're paying property taxes, state income taxes, local income taxes, sales taxes, things of that nature. If you have a piece of real estate that's worth a little bit of money, it's not crazy to see $10,000 property tax bills these days, right? So they have increased that to $40,000. So that is pretty effective in terms of increasing the ability to deduct those state and local taxes. That's a hot button issue because I think it's a political stance between, hey, high tax states shouldn't get this benefit that low tax states don't, depending, someone who lives in New York, especially New York City, or lives in California, might have a lot higher state and local taxes versus someone who lives in Missouri. So why does that taxpayer get more advantages than the next? Kind of goes back and forth, right? That one as well is not permanent. So that's going to be back on the playing field in a couple of years as well. And it's kind of a political stance that goes back and forth. So that's a planning item in my mind for those who pay a lot of state and local taxes to think about, hey, it's going to be okay here for a little while. But that might be back onto the drawing board again into the future. So a few more that I think are important that are less like individual tax and more business related. If you've known this probably for a while, because it's been the same number forever, if you pay someone over $600 via cash or check, you're supposed to send them a 1099. There are rules that the IRS has that says if you do not do that, there's actually substantial penalties and fines. There's a lot of non-compliance with it, but the fines are pretty staggering. Essentially, they're saying that you need to pay the FICA taxes for that person you did not send the 1099 to. Well, they bumped that to $2,000, which is going to be nice for a couple of reasons. It's a huge administrative burden to file all these 1099s and chase people down for their information. If you don't have your systems dialed in, you're trying to chase down information from people after you've already paid them, and then they don't want to tell you because they don't want a 1099, right? All these things. So that bumping to $2,000 is going to provide a lot of relief, because you wouldn't believe all the books I look at, how many people are like 800, 900, 1200, like that one little thing you get done. This helps with that.
And I mean, and that goes to help. I would assume that helps a lot of the folks. Like if you paid somebody to mow your lawn a couple of times throughout the year, or do some off, one-off things, maybe summer type jobs, like it just kind of removes that burden to a certain degree.
A lot of the one and dones, like you had somebody come out to the office to freshen up your landscaping. It was $1,500. Well, now you don't have to go in and get their W-4 filled out and get their EIN number or their social security number, and your accountant doesn't have to file 1099. It's going to bring down the total filing amount down, which is good for all parties, including the IRS, because they get way too much paperwork anyhow.
Right.
The other one, we had an episode about this. It was like a tax tip I talked about. Essentially, we talked about if you had a C Corp, if you sat on that stock, say you created the business and sat on it for 5 years, you could sell it after 5 years and not pay any capital gains. Well, they actually created a new window in there for if you sell at year 4, you can avoid 75% of the gains, which is really interesting, because I think that's the hard part about that strategy is, what if I get an amazing offer at year 3, 2, 1, 4, well, now it opens up a possibility for you to exit year 4 and still avoid a ton of tax. So we had an episode about that, one of our previous kind of top tax tips, but it's a very effective strategy for startups. You're talking essentially, if you get this, I'm going to create the next big software. I'm going to create QuickBooks as competitor, because QuickBooks is on my mind right now and driving me crazy. And you get a bunch of fundraising and you get all these customers, and then boom, who knows? Microsoft wants to buy you for $50 million. Well, if you held it for 5 years, you could avoid all the gain on that. And it's like one of the biggest tax advantaged laws that have ever existed. And they've opened that up to where you could sell in year 4, and they've actually made that a permanent part of the tax law too. So that's one that's used by a lot of the big companies and big players in that space as well. So, the big thing I think to take from this is that there were a lot of, big promises. I think like most things, the promises were kind of half-heartedly filled. I mean, there's some good things in here in terms of extending TCJA that's really important for small business owners, because that QBI is the big one sticking around, that 20%.
Yeah.
The state and local taxes thing is going to provide some relief for a significant amount of taxpayers as well. Although that one's not permanent, which I don't like. But the permanence of TCJA is, I think, the biggest impact of this bill, because, while not getting taxed on overtime and tips is great, it is temporary. And I hate when that happens, because the average taxpayer is not going to know or remember, and it's going to hit them, kind of hard one year, because they set up all their withholdings they're used to getting either nothing back or breaking even or getting this refund back. And if they don't see that coming and they get slapped with paying thousands of dollars in taxes, that really hurts the average American. So I don't like the short-term stuff. I get it when it's business related and big business related because we want to spur some activity, in something for a short period of time. But when it's with the individuals, it is a little disheartening for me just because I know there's going to have to be an education campaign going into the tax year that it's turned off unless they, get together and come back at it again and make it permanent. Any of this stand out to you, Grant?
Yeah, I think, obviously we're in the business owner seat. I think the QBI thing's a really big deal, and we don't want to underplay that too much. I think that is something that, for myself, for a lot of other folks that, network with, especially other folks who are maybe doing like the freelancer thing, just getting started off, like that's a really big deal and something that, if you haven't ever looked at that before, or, maybe you're just, because I got pretty educated about it in the last couple of years, just how all that worked. And, as businesses scale, I think that's something to really take a look at. Make sure that you're doing that right, and make sure that whoever's doing your books or whatever, like you're working with a consultant with, because like that can have some significant savings. And then I think too, just continue to watch what is, to what you're saying, permanent into law, and what are the things that are going to come up, because for the lay person like myself who, you try to know enough to be dangerous, but I think it just goes back to the importance of making sure that you are always watching your books, you're watching your taxes, you got a good person doing your books. And if you are, somebody who likes to file by yourself, like you really got to be up on knowing certain things and understanding what you're doing.
Yeah. QBI is probably one of the most impactful small business tax, laws or cuts that we've seen in a long time. Because one of the big issues with hanging your own hat and being self-employed is that those pesky self-employment taxes that you get to pay the second half of really dig into your total taxability. And I think what QBI did was really help mitigate that and really help level the playing field with, like, when you talk about a freelancer, kind of leveling out if I make $50,000 at a job and I make $50,000 as a freelancer, that net down number after tax is not nearly as big of a difference as it was before that, because that's 20% of that net profit you're getting back as a deduction, which is really important when you consider all of self-employment taxes are 15%, 16%, without that, I think we would really have a hard time getting more people to join the freelancer community or join into entrepreneurship because of how much extra it takes in terms of income to make to get to the same spot you were before.
Correct.
And I always love to see tax law that incentivizes that,
entrepreneurship.
And we're not talking like corporate America stuff here. We're talking about somebody who just wants to hang their hat and do honest work and make a reasonable living as their own boss, you know? And I really appreciate that's going into these tax laws and is being looked at because, as much as I do, that a lot of things happen at really big levels for big businesses. And it's hard for the average person to feel that. And these are tax laws here that I do feel like a lot of, everyday, employees that you have are going to feel, as well as the entrepreneurs that are in your community that are not, Fortune 500 companies.
Yeah. And I think the one other thing that I'll just quick add in here, just kind of anecdotally, we're talking about a lot of this is things happening at the federal level, things that are happening through Congress with the IRS, all those big dogs. And I think one of the things to keep in mind, and, I hope people continue to stay active and just stay educated, is that, your local governments, your city governments, county governments, even state to some degree, like those are where you can continue to have more. I don't want to say you don't have input at the federal level because you do with who you vote in.
Yeah, right? But you have more influence.
But you have direct influence with some of these local stakeholders. And so, if you've got questions on things, or, I know a lot of times that local people get blamed for a lot of things that are completely out of their control at the federal level. Just stay active in your local communities. I mean, ask it again, if it's city council folks, if it's city managers, if it's your, trustees, if it's your county commissioners, like they do still have a voice. And that my hope is that, just generally speaking, that we can keep a decent amount of the money and taxes locally to be spent by local people and where the communities see the need for it. And so, I would just encourage everybody, and this is something I've done even more the last year, like be more active with those local folks, because you have a lot more to what you were saying, direct influence on where some of those funds go. And so, yes, you hear all about this things happening at the federal level, and that's the talking points and the things you hear on the news. But there's a lot of stuff happening at the local level where, you can have some really important influence. So make sure you're always staying involved with that.
Yeah, specifically in state government and down is when you actually see most taxing is approved by ballot issue. By voting.
Right.
And you don't get the vote for the federal tax rate. Now you get the vote for legislators to help do that.
Correct.
But that's where all the lobbying and special interest groups and all that gets involved. And when we're talking state, local taxes, most of the time you get a voice, yes or no. And in your very small pool of voters most of the time. Now, if you live in New York City, it's still big, but it's much smaller than the federal government. And as an individual, you had the ability to influence the direction of those votes by, educating your community or getting more involved or talking to the elected leaders. And you're going to have a much higher chance of inputting change that way than you ever would at the federal level. Because while you can vote for whoever you want to and try to get the things that you want at the federal level, it just gets so much more convoluted with all the special interests that are involved. And you have so much less of that on a local level. I think we've talked about it before, and I said it again. It's like, the more we strip away local tax, the less control we do have. Well, tax is frustrating as business owners and as individuals, but I would much rather see, advantageous tax laws at this federal level. And then that gives us the ability to talk more about what's being done locally rather than the fundraising being done up here at the federal level. It's just one of those things. It's also, as simple as it's really hard for me to call the IRS and get stuff as a tax pro. But I can call the local city taxing authority and they pick up and we can have a 15-minute conversation immediately. There's a lot of value to that, in my opinion.
Absolutely. Well, as always, thank you all for joining this episode. Hopefully, whether you're a business owner, an employer, an employee, maybe somebody getting close to retirement, I think there's a little bit in here for everybody. So as always, if you have any questions, reach out to Tyler. You can reach out to me. I'm going to forward you to Tyler, maybe even a lawyer. But yeah, hopefully everybody got a little bit out of this episode. And until next time. Thanks again for joining us today on the Next Gen Strategies podcast.
Be sure to follow the show on Apple Podcasts, Spotify, or wherever you get your podcasts.
And if you really enjoyed it, give us a share on any of your favorite social media channels.
And don't forget to leave us a review.